All right, good morning, everyone. My name is Sarah Grimes. I'm the director of NYSARC Trust Services, and we thank you guys so much for coming today to learn more about how you can use a pooled trust to help someone qualify financially for Medicaid home care services. Now, for any of you that are just joining us, and I know we've got a few questions in the chat, we will be providing a copy of these slides to all attendees following today's training. And everyone is muted by default, just to limit background noise. So we encourage you to use the Q&A area to submit any questions that you have throughout today's training, and we will reserve some time at the end to go through those questions. Again, for anyone who's just joining, for some reason our chat is disabled, so we encourage you to communicate with us using the Q&A function, and we will organize those questions and go through them at the end of today's training. This is just a quick reminder before we get started that this training is being provided for educational purposes. So this information should not be construed as legal advice. Every person's situation is very unique. We're going to be covering this information at a high level, and some of you may be watching this training many months, many years down the road, and some of this information may change. So please just be mindful of that. A quick run through of today's topics of what we're going to be covering. We're going to start by providing a basic overview of what is community Medicaid and what are some of the benefits that a person can receive in using community Medicaid, and what are those financial limits that they need to meet in order to qualify for those services. We'll talk about what a Medicaid spend down is and how a pooled trust can help someone meet that spend down requirement in order to become financially eligible for these services. We'll talk about who is eligible to use a pooled trust and when someone might choose to use a pooled trust. So why would someone join, and how do we help them get started? We'll also talk about, once we get someone into the trust, what are some ways that they can use the funds that they're putting into the trust to help support their monthly expenses and be able to stay in the community for as long as possible. Throughout today's training, we're also going to be providing you guys with some updates on new services that NYSARC is offering to help individuals we serve be able to manage the funds in their account, as well as some interesting Medicaid changes that are currently happening, as well as ones that are on the horizon. Some that are positive changes and some that may make it difficult for people to qualify for these benefits in the future. Now, in New York State, we're very fortunate. We have a very robust Medicaid program. And community Medicaid benefits can help individuals in New York State be able to pay for health benefits that may not be covered by other insurances that they have, whether that's Medicare benefits or just private health insurance. And also community-based long-term care services like home care for people with disabilities and adults who qualify by meeting the eligibility requirements and the financial limits. Now, community Medicaid in New York State can offer services like basic health care, offsetting costs of co-pays, prescription drugs, as well as transportation to medical appointments, dental coverage. We know many older adults who are no longer in the workforce. They may no longer be receiving dental coverage because they no longer have an employer providing that benefit. So Medicaid can be an option for someone who's looking for dental care. Letting dental care go for too long can also result in other types of health issues. So that's something we definitely want to get taken care of, and Medicaid is a way to help someone do that. Beyond that, it covers a variety of community-based long-term care services, as well as nursing home care. Now, we're going to be focusing today on community benefits because that is the program that a pooled trust can help a person qualify for. Once someone goes into a nursing home, they are going to be receiving a different type of Medicaid, and they would no longer be eligible to spend down their income in a pooled trust. That money would then go to a nursing home to contribute towards the cost of their care. And we'll go through that in more detail as we walk through how this process works. Now, in order for a person to be eligible for community Medicaid benefits, there are income and resource limits that a person needs to be below in order to qualify financially to receive these services. Now, for 2022, the non-Magi Medicaid income limits for a single individual or an individual applicant is $954 a month in income, and they can have up to $16,800 in assets. And those assets are going to be things that are non-exempt assets and things that can be easily turned into cash. So your checking account, your savings account, that's going to be considered an available asset to you. Things like investment accounts, the cash value of a life insurance policy that can easily be turned into cash. Essentially, any assets that Medicaid might consider to be available to you that could contribute towards the cost of your care. Certain assets are exempt, like your home. Your primary residence, as long as it's below a certain value, is going to be exempt when you apply. However, many individuals, that may be their largest asset. And while you can have a home and become eligible for Medicaid benefits, you may want to ensure that that home can then go to your loved ones in the future. And you don't want that to go to Medicaid to repay them for the services that were provided you during your lifetime. So even though your home is exempt when you apply, you may still want to do some work to protect that home so that you can ensure that it can go to your loved ones. There are also other ways to help get yourself down below these asset limits if you have money in the bank or investment accounts that need to be spent down. Typically, people are going to go to an elder law attorney or someone who specializes in trust and estate planning, and they have a variety of options that can help you get your assets below the limit so that you're able to qualify for these benefits. But many individuals, even those who might not have assets, still are going to have a difficulty meeting the income limits in order to qualify for services. Income can come from a variety of sources, primarily your Social Security retirement check. Perhaps if someone's enrolled in Social Security disability, it would be a disability income. It can also be any source of income you receive, such as money from a pension, distributions you may be taking out of your retirement accounts, alimony payments, child support. Any source of income that you have, Medicaid is going to add that up to determine what your total monthly income is. And any amount that you are over that $954 limit is going to be considered your excess income. Now, the important thing to note here is that even if your income or assets are above these limits, there are options that can help you qualify financially for these benefits. So we're going to talk about those in more detail throughout today's presentation of how we can help you, even if you think that your income or assets are too high, how we can help you get down below these limits so that you can be financially eligible. There are also other income and resource limits depending on your household size. For a married couple, when you're both applying for Medicaid benefits, that income and resource limit is slightly higher. In other situations, and this is honestly probably more common, there's one spouse who's in need of care and another spouse who may not need care at that time. So there are other budgeting options that would allow married couples to potentially have more income and more assets available to them so that they can reserve some of that money for the healthy spouse in the event that they need care in the future. Now, again, I can't stress this enough. When you are navigating these types of situations, it can be very beneficial to be working with a professional who understands these rules and can help you determine which avenue would be best for you in your situation. Everyone is very different. Now, before we move on, I also want to share some exciting news that was recently announced during the governor's budget this year in past April. One positive new update for the Medicaid eligibility is that we have seen a significant increase that is going to be coming in January of 2023. Now, this is an estimated calculation of that increase based on the current numbers for 2022. So these will not be the numbers as of 2023, but this is just to give you an example of how significant of an increase this limit will be. The governor has passed an update that we're going to be looking at an increase of 138% of the federal poverty line in 2023, raising the income and asset limits for individuals and couples by a significant amount. And the purpose here is to help those individuals who are eligible for Medicaid prior to age 65, who are not receiving Medicare benefits. When they then turn 65, they're often now subject to more strict income limits, as you can see from the levels we're at 2022, where prior to turning 65, they were able to qualify for Medicaid as long as their income was below that 138% of the federal poverty limit. So this is to help make it so that those individuals don't have a need to spend down income at a time when they need the care the most. We've also gotten a pretty big bump in the asset limit, and that's going to help those individuals who might not have those other exempt assets. Maybe they don't own a home, or they didn't have a job where they were able to save for retirement. Those assets are generally exempt for Medicaid eligibility purposes. Now, someone that has, $20,000 in a savings account would, under the current rules, be required to spend down some of those assets before they can be eligible. And so this is meant to just make it easier for those low-income individuals to be able to access these services without the need to spend down. So this is very exciting. This means that many of the people that would be looking for these services in the future may be able to qualify without having a spend down and without needing to use a tool like a pooled trust. Now, for those of you who may be joining this or learning about this subject for the first time, we're going to give you a quick overview on what a Medicaid spend down is. It's a term that we're very familiar with here. Some people whose income is above these limits, they're able to spend down that income on a monthly basis and become eligible for services. So again, even if your income is too high, it doesn't mean that you cannot access this benefit. The amount of your income that's over that limit is referred to as your excess income or your surplus monthly income. And for individuals who have a qualifying disability and adults who are over the age of 65, they're able to spend down that excess income on a monthly basis and be eligible for services. This is called their spend down or Medicaid income spend down. Now, an individual has a couple different options to meet that spend down requirement. They can simply cut a check to Medicaid for the amount of their spend down on a monthly basis, and that would qualify them to receive those services. That can be beneficial in a situation where someone has a very low spend down, like $50. Some people are just over that threshold. This is like paying a premium towards your Medicaid. You simply pay that money to Medicaid or your local Department of Social Services, and after you have met that spend down, they will activate your services for that month. Another option is to use that money towards the cost of your medical bills. If you have medical bills that you're already paying every month, you can pay those co-pays, pay those prescription drug costs, and you can submit receipts to Medicaid up to the amount of your excess income. And once you've submitted enough receipts, you would be eligible for Medicaid that month. Now, that works for some people who have a low spend down or may have medical expenses that they need to pay anyway. But it can also be challenging even if you do have medical expenses, because it means that it's not until you're able to pay all those medical expenses throughout the month that you would be eligible for Medicaid to pick up the cost of your care. And for people who need Medicaid for home care services, they need that Medicaid activated at the beginning of that month. So there's another option. Instead of giving the money to Medicaid or using it towards medical bills, you're able to deposit that money into a tool called a pooled trust. By putting the money into the pooled trust, it does meet the Medicaid spend down requirement to activate your services. And the real benefit is that it allows you to use that money for non-medical needs. It allows individuals to be able to use that money for the things that they really need it for, their monthly living expenses. That is going to allow them to be able to stay at home for as long as possible because they can continue to afford to pay those monthly bills. Now, what is a pooled trust? This is a trust that is allowable both under federal and New York statute. We get questions all the time by seniors and families who are considering this option. Is this legal? What if Medicaid finds out? We're going to inform Medicaid. We have to tell them that you are using a trust to pay your spend down. So rest assured that this is a program that is completely legal and a tool that is available, specifically designed to help people with disabilities be able to access these means-tested benefits if they have money in their name that would otherwise disqualify them from receiving these benefits. A pooled trust is a special type of irrevocable supplemental needs trust. It's irrevocable in order to protect a person's eligibility for benefits. That means once you set up the trust and put your money into that account, it becomes the property of the trust. And that is then managed on your behalf to help you pay expenses that are eligible. It means that you can't return that money to you or put that money back into your bank account. But if you choose to no longer use the trust or you no longer need Medicaid benefits, you're simply going to contact the trust, inform them that you no longer need it, and spend down the money that's in your account on eligible expenses. Now, I did mention this is a program that's available to people who have a qualifying disability. So this is for people with disabilities to be able to access these means-tested benefits. So if you're receiving SSDI or SSI, you're likely eligible to use a pooled trust to spend down income and assets that you might have in your name that you need to get below the limits in order to qualify or maintain your eligibility for these services. For older adults, they often don't necessarily consider themselves to be disabled. However, many of the things that go along with getting older can qualify someone to use this program. And you may just need to fill out some extra paperwork when you apply for Medicaid so that the individual can be formally deemed disabled in order to use a pooled trust to spend down their excess income. What's unique about a pooled trust is that these are managed by nonprofit organizations who take ownership of these funds and distribute them on behalf of the individual who's in need of services, known as the trust beneficiary. You're going to hear me use that term a lot throughout today's training. The funds in a pooled trust are truly pooled into one bank account. That's for investment and management purposes to make it easier for us to administer these accounts for a large group of people. But each individual that's participating in the trust, their activity will be tracked in a separate sub-trust account. So whatever money you put into this trust, minus any costs of the administration of the trust, are available to you to use for the things that you need that are for your primary benefit. And we'll talk more about what some of those eligible expenses are. One caveat to this is that Medicaid allows you to divert this money into a trust so that you can use it to pay your expenses so you can stay at home and pay for things that may improve your quality of life. But upon the death of the trust beneficiary, it is a federal policy that that trust account must close. And we can't make any payments out of that trust before repaying Medicaid for the services that were provided to you during your lifetime. So it's very important to be submitting requests to the trust on a regular basis, as most people are doing, because they need this money on a month-to-month basis. There should not be a large balance in a person's account upon someone's death. Now, what's different about a pooled trust is that a pooled trust being run by a nonprofit, rather than repaying Medicaid with the money that's left in that account, that money is typically retained by the not-for-profit organization like NYSARC that is administering the account, and it's used to provide for services for people with disabilities that are served by their philanthropic mission. So rather than this money going back, if there is any money in the account upon a beneficiary's death, going to repay the states that provided Medicaid services and going into the big Medicaid budget. This money goes directly back into local communities and is used by providers who know the needs of the individuals that are in their area. It can pay for unfunded programs. In our case, the funds are used to provide for recreational opportunities, guardianship services, and other unfunded programs for people with intellectual and developmental disabilities that are served by chapters of the ARC New York. So the primary purpose of using a pooled trust is to help a person qualify or maintain their financial eligibility for services in a situation where they have money in their name or they're coming into a sum of money that might make them ineligible financially to receive Medicaid services. By spending down your income or assets to qualify for Medicaid, an individual is able to pay for medical expenses that Medicare doesn't cover. It allows them to get things like long-term care services, again, a benefit that is not covered by Medicare for any sort of extended period of time, allowing them to get care and therapy services from the comfort of their own home, assistance with activities of daily living so that they can get help with the things that they can no longer do on their own. They can get oversight and monitoring and someone to be there with them when a loved one may not be able to be. They can assist them with things like cleaning the house, cooking, dressing, bathing, medication management, really whatever services that that individual needs to be able to live and stay independently at home for as long as possible. And this provides many people in New York State with an alternative to having to go into a nursing home, because there are plenty of individuals that can be safely provided services in the community. And by using this program, they can still afford to pay their bills so that they can stay at home. In addition to helping the beneficiary who's in need of the services, this program can help provide respite and financial relief to family caregivers, someone who might be contributing towards the cost of a person's care. Many families are private paying for services before they recognize a need to use Medicaid benefits, how that can help kind of offset those costs for them. It can also provide respite for a family caregiver who might be providing these services as an unpaid caregiver, help them so they don't have to quit their job or constantly be having to leave work to go care for mom or dad. They're able to get services in place so that they have the peace of mind knowing that someone is with their loved one when they're not able to be. Now, here's an example that we're going to use to help us walk through how this works in the real world. And again, this is just an example of one person. Every individual's situation is very unique. Here we have David. He is in need of Medicaid services. He's 76 years old and he is single. He lives in Albany, New York, and he has Parkinson's disease and some mild cognitive decline. His daughter, Mary, is really wanting to make sure she can keep him at home as long as possible, but she's struggling to provide the care that he needs as his needs are progressing, and she's very busy with her own family. So he would like to apply for Medicaid so he can get a home health aide to come in and assist him with the tasks that he may not be able to do on his own anymore, and to help give Mary some respite and peace of mind. Here's a breakdown of David's income and resources. He's got some money in checkings and savings. He's got a retirement account, which funds in a retirement account are typically that principal balance is going to be exempt from Medicaid eligibility purposes as long as that account is in payout status, as long as you're taking money out of that account. So the principal balance of his retirement will be exempt when he applies, but the money that he's taking out of that account will be counted towards his monthly income, as you can see in the right-hand column. He also has a home. It's $300,000 value. So that, again, is going to be exempt when he applies for services, but he may still need to do some work to protect that home to ensure that it can go to his daughter upon his passing. So looking at the total assets that he has available to him and deducting out the $16,800 that he's allowed to keep, he has an excess asset of $83,200. So well over the Medicaid limit. His monthly income comes from a Social Security check. He's got a small pension and that distribution from his retirement account, as I mentioned earlier, for a total monthly income of $3,358 a month. Now, again, this is a very simplified version of this calculation. There are many factors that can come into play when we're calculating a person's spend down. So I want to make sure I specify that this amount is determined by Medicaid during your application process. You can certainly work with a professional who can help you calculate this amount, someone that may know these rules very well. But this is something that you should not necessarily just kind of take your income, deduct out the Medicaid limit, and start using a trust. You want to ensure that you go through the process of allowing Medicaid to determine this amount. They're going to tell you right down to the very penny how much you are over the limit. Once we've deducted out the current Medicaid limit for 2022, we have an excess income of $2,404 a month. Now, again, for somebody who might have had slightly lower income under these new rules that are coming in 2023, had his income been around $1,500, he would not need a trust to spend down income on a monthly basis once these new rules go into effect. However, even in David's case, his income is high enough that even after these new rules go into effect, he will be required to pay some money into a trust or to Medicaid in order to access these services. So how does this process work? How are we going to help David become financially eligible for Medicaid home care services? The first step, and it's important to note that the order of these steps may vary. In David's case, he has resources in his name that he first needs to spend down in order to be able to start that Medicaid application process. Some of the individuals you're working with, or for people who may be on the call looking for these services themselves, you may not have resources that need to be spent down. And so in that case, you would go straight to step 2 and begin that Medicaid application process so that they can assess the amount of your income that may be over those limits. For someone who's already receiving Medicaid benefits and has an income spend down, but they're struggling to pay that spend down, or maybe they're submitting bills to the Medicaid and they're not getting their services activated until later in the month, they can typically skip straight to step 4 and apply for a pool trust to start putting their spend down into the pool trust so that they're able to use that money for living expenses and non-medical purchases. But in David's case, we're going to start at step 1. He needs to go to a legal professional who's going to help him protect any excess resources that he has and to put his home into a trust so that he can ensure that that can transfer to Mary upon his death. Once he's down below the resource limits, he can apply for Medicaid benefits. And this process can take a couple of months between the time that you start the application, collect all of the documentation that you need to verify your financial eligibility. And he may also need to obtain a determination of disability from the Department of Health. This is a couple of forms that need to be filled out with your Medicaid application, and it's what's going to make it possible for him to spend down his income in a pooled trust. Once he has gone through that process and the Medicaid has determined what his spend down can be he can then apply for a pooled trust to put that spend down money into the account and activate his services. Now, the pooled trust is a pretty quick and easy process. You're applying to join a program, you're filling out an application to join, and it can be open in about a week's time. Even faster, 24 to 48 hours in situations where someone needs to get an account open quickly. Just need to contact a pooled trust and let them know you have to expedite that application. Now, depending on where you are in the state, this process also may vary. Some counties, and oftentimes in the New York City area, HRA wants to see the pooled trust application with your Medicaid application because they want to use that as an indication that you need to initiate that disability determination process. Other counties don't require that, and you may be able to wait until you've received notification of your spend down to set up a pooled trust. So if you have a question about when to apply for the pooled trust, we encourage you to contact your local Department of Social Services or Medicaid office. Inform them that you know you're going to have excess income, you intend to use a pooled trust to spend down that income, and ask them when they need to see that paperwork. Because as soon as you open up a pooled trust, you're going to incur the enrollment fee to join, and there will be monthly fees to administer that account. Once you've gone through that process, you can begin putting your monthly spend down into the pooled trust on a monthly basis. Medicaid does need to be aware that you're using a pooled trust to pay your spend down. Otherwise, Medicaid or your managed long-term care plan may be sending you letters and hitting you up for that spend down amount. So as I mentioned earlier, we are going to inform Medicaid that you are using a pooled trust to meet your spend down requirement by sending them a copy of your executed joinder agreement, your acceptance letter for the trust, and in some cases, they may also want to see a verification that you've made your deposit into the trust, which is something you can contact the trust for, or in our case, we have an online portal where you can download a report showing your deposits into the trust. Medicaid will then come out and provide an assessment to determine the hours of care that you're eligible to receive. And the funds that you put into the pooled trust each month can then be used to pay your monthly living expenses and make purchases of items and services that are going to improve your quality of life. Now, as I mentioned on the previous slide, there are costs to set up a pooled trust. Every pooled trust is a little bit different, so we encourage you to look at the fee schedule for the particular program that you're reviewing. On the slides here, I have our fee schedule just as a reference. Most pooled trusts are going to charge a one-time enrollment fee. That is a one-time fee to establish the trust. In our case, that's $200. I've seen it as low as $175 and as high as $350. So again, you want to be looking at the fee schedule for the program that you are considering. Once you pay the enrollment fee to join the trust, there are going to be monthly fees to administer the account and help you use the money in your account to pay your bills. In our case, we charge a flat fee that's based on the amount of your spend down. That covers all of your activity in the trust with no limit on how many times you can call the trust, what services you have access to, and no limit on the number of requests you can submit each month. Other trusts might charge fees based on a percentage of the amount you deposit each month. Some may also charge a low monthly fee for a certain number of requests, and any amount of requests you send in above that limit would be charged at an additional fee. So again, we encourage you guys to do your research and understand the complete fee structure for any trust that you're considering. Beyond that, in our program, we do charge a one-time a year tax and audit charge of $50. And that is for the trust to perform the tax preparation that's required each year. And we also have an independent CPA firm come in and audit our operations. So that's charged every year in July. And it's deducted out of the amount of money that you have in your account. And that's the case for all of these fees. This is not necessarily something that you need to come up with on top of your spend down. These fees will be deducted out of the amount that you deposit into the trust. And again, in our case, we have no limit on the number of monthly disbursements that you can send in. And we do not charge any sort of annual renewal fees. But that is something that other trusts may charge. So it's important for you to understand the full fee schedule for any trust that you're considering, so you can determine approximately how much money you're going to have available to use for your bills. Now, here are the steps, a quick overview of the process of how you apply for a pooled trust. The individual who needs services is going to need to complete the joinder agreement and sign that document and have it notarized. This is a legal document but we're looking for basic demographic information about the individual. Who are you? What's your contact information? What services are you receiving? What is your living arrangements? It's going to allow you to authorize individuals who can have access to your account and who can help you manage that account in times where you need that. In some cases, the individual, and David would be a good example, may not have the capacity to sign this document on their own. And so it can be signed by someone who has the legal authority to do that, like a power of attorney or a legal guardian, a parent or grandparent in the case of someone that needs to spend down assets for Medicaid or SSI purposes. Once you've completed the joinder agreement and that's signed and notarized, we're going to need a copy of the beneficiary's Social Security card, a copy of their Social Security award letter, or they're able to provide us with an SSA 1099 form that will give us everything that we need to get the account open. Beyond that, they'll need to send funding to establish the trust. In our program, we ask them to open the account with a minimum of $300. That's going to cover the $200 one-time enrollment fee to join the trust, and that remaining $100 will be in their account, and that's going to go toward the balance of what's in their trust account. Other people who are establishing the trust and know what their spend down is, as long as it's greater than $300, they're able to open the account with their first spend down deposit, and we'll deduct the enrollment fee and the monthly fee right out of that amount. A person can fund the trust electronically by filling out a form and asking for a one-time electronic deposit from their bank account. And they can also mail a check. There's a deposit slip for this, and they would want to mail that check separately from their joinder agreement because that has to go directly to the bank. Again, this is our process. Each pooled trust may have a slightly different format for how they have the application, but generally all pooled trusts have a joinder agreement to join. There's going to be supporting documentation that's required and initial funding to open the account. Some of you also may not be aware that we have recently reduced the minimum balance requirement, allowing people to have more access to the money in their account in that first month. For those people who are making monthly electronic deposits of their spend down, we are only requiring them to hold $100 in that account rather than the full amount of their spend down. If you have questions about this process, we have a great video on our website walking you through step-by-step instructions of how to open up a community trust account. Now, there are some rules of how money in the trust can be used. Once you have gone through the application process, started to make your deposits, everybody wants to know, what can I use this money for? Now, the primary and the first and most important rule is that money in this trust account must be used for the primary benefit of the trust beneficiary or the Medicaid applicant, the person receiving services. So that means we can't buy gifts for other people with the money. And we're typically going to be prioritizing paying things that are bills in this person's name or expenses, items, and services that are for this person's primary benefit. We're also going to consider how any sort of distribution out of the trust could impact a person's financial eligibility for benefits. Now, for someone who's receiving Medicaid home care services, there aren't many things that the trust would be paying for that could potentially cause a reduction in their benefits. But one might be hours of home care, for example. Home care is supposed to be being provided by Medicaid. That's the whole purpose of using the trust to get those Medicaid benefits. So the trust is only going to be able to provide for additional hours of care that go above and beyond what a person is receiving from Medicaid. In the case where you have enough money in your account and you may need some additional hours, you can use the funds in your trust account to pay for those additional hours. For someone who's receiving SSI, so this is typically not going to be someone who's using the trust for a Medicaid income spend down because they generally qualify for SSI because they have low income. but we cannot pay for food and shelter items out of a trust without potentially causing a reduction in their SSI payment. And for someone who's a minor in the trust cannot pay for items that are considered to be a parent's obligation. So again, as trustee, the nonprofit organization is going to review each request individually to consider how it could potentially cause an impact or reduction in a person's benefits before considering any sort of payments out of the trust. All disbursements must be substantiated by some form of supporting documentation. So typically a copy of a bill, an invoice, or a receipt for something that was purchased for our beneficiary. And then the trust is going to distribute funds for eligible expenses to a third party. As I mentioned earlier, we cannot give cash out of this account to the beneficiary or their spouse or legal guardian. And we cannot transfer money into their checking account. That would make this money available to them. And it would undo the protection that we've created by putting the funds into the trust. So we don't pay you back and we don't give you money back to pay your bills. We pay your bills directly to the third party business, like to pay your, cut a check to your landlord to pay your rent, cut a check to your electric company to pay your electric bill, or we can also reimburse a third party who went out and bought something for you and would like to be repaid for that expense. Distributions are made at the sole discretion of the trustees, and that is to ensure that the funds are used in the best interest of the individual. But and we know that many people, one of their biggest reservations about using this trust is that they feel that they're going to have a loss of control over their money. It's important for people to understand that the funds going into the trust are there to be used for your bills and your expenses. It's really just a way of getting that money out of your name. The trust is not going to direct how that money is being used. We're going to rely on you, the beneficiary, or your families, or other people who are assisting you to inform us of what bills you need to use that money for. And then we're going to pay things out of the trust based on your requests. So that rule of the sole discretion is to ensure that the individuals that we're working with aren't being taken advantage of, that someone isn't trying to get access to their income. So we're monitoring how it's being used to make sure it's used for them and for their bills. It's also so that if we get a request from somebody to buy a big screen TV, but we know that that individual needs to use that money to pay their rent, we're going to make sure that their basic needs are met first before we go out and buy them a TV. So again, that rule is just to ensure that this money is being used appropriately and wisely to help this person stay at home for as long as possible. Another way to help the individuals that you're serving feel like they have maybe more control over their money, they can go out and leave their bills being paid on a credit card. Some people often say, I have all my bills on automatic payment. Well, you can leave it that way. Have your bills automatically paid from your credit card each month and submit your credit card statement to us each month. And we will then pay your credit card company for those bills that are on the statement. So you can still maintain control over making sure your bills are being paid and being paid in a timely manner, and simply submit that credit card statement to us once a month and the trust can pay for that expense. And as we've noted, there can be no payments out of a trust after a person's death. So we encourage you to consider an irrevocable funeral burial plan during the person's lifetime, so that that money can be used, if there is money available in a person's account, to cover the costs of any sort of funeral or burial services that they may need or want. Stay in communication with the trust and be sending requests in as you have them, so that you are not in a situation where someone passes away suddenly and you're no longer able to get access to the money that's in that account. So now that we've gone over some of the examples of things that David can use the trust for, let's talk about how much money he's going to have available and how we may help him to determine what bills he's going to pay out of the trust. So David's total monthly income is $2,404. So the first thing, we're going to deduct out that Medicaid income limit, leaving him with excess monthly income of $1,450. Then we're going to subtract out the cost of the trust, which is going to be deducted each month on the first of the month, leaving him with approximately $1,360 to pay towards his expenses each month. Now, looking at that, we're going to try and find one or two large bills that he can send to the trust so that he is limiting the amount of paperwork that he needs to send, so that he can focus on, or his daughter Mary can focus on ensuring that he's getting the care that he needs. We want to try and simplify this process as much as possible so that the people that we serve do feel like they have as much control as possible. So we're going to pick things like his rent, which is a large expense of $1,000. And that's something that can be paid automatically each month by filling out an automatic payment application, sending us a copy of his lease. We can pick a day of the month and pay that rent every month on that same day. And he doesn't have to send in a request every single time he needs to pay that. He only needs to contact the trust if there's a change to his rent, either an increase or a decrease or a change to who we're going to pay. Another bill we are going to look at, I recommend people choose bills that you can always go get another copy of. Because yes, you can use the trust to buy groceries, but we need to see itemized receipts for those expenses. And a lot of the individuals we serve have so much going on, it can be difficult to keep track of all those receipts. So I usually recommend you pick larger bills, things that you know that you can go get another copy of, so that you always have that documentation. We need that so that if Medicaid comes to us and wants to know how that money is being used, we can show them proof of what the funds in the trust have been being paid for. So we're going to look at some of his larger bills that he has on a monthly basis. Things like his utility bills, his cable, cell phone, and then he still has about $100 left that he can use his credit card to go make purchases throughout the month, whether that's for food, clothing items, over-the-counter items, or other personal expenses that he might have. Utility bills is another thing that can potentially be put on automatic payment as long as it's a fixed recurring expense, meaning that someone is enrolled in a balanced billing or a budget plan. So again, we're going to want to try and determine bills that can be paid automatically each month or larger bills so that rather than feeling like you're losing control of your income, the individual has the peace of mind of knowing that these bills are going to be handled by the pooled trust each month. It gives them that flexibility to use the money that they are not depositing into the trust for those monthly purchases and spending money or pocket money that they may need. And the important thing is that they're receiving the very valuable benefit of tens of thousands of dollars in home care services each month that they are not having to pay for, that Medicaid is going to provide for them for that nominal monthly fee of $90. Now, here's a quick overview of the process of how money flows in and out of the trust. Each month, the individual is going to be required to deposit their excess income directly out of their income into the trust. Now, it's very important to point out, this money must come out of the applicant's own income. It cannot be paid by a family member. That would not meet the spend down requirement and could cause your loved one to be ineligible for services. So we know families, you're trying to help out, but it may actually negatively impact your loved one's eligibility for Medicaid. Funds can be deposited into the trust either electronically from your bank account. You can set that up as a monthly recurring payment to the trust. That's certainly the easiest and the fastest way to make this process as automated as possible. Or for those that aren't comfortable with that, they can mail a check every month for the amount of their spend down. Once the funds are in the trust and you have money available for disbursement, you can submit requests to the trust by fax, mail, or email. You're going to fill out a request form telling us what you want us to pay, what amount, and who that payment needs to go to. And you're going to attach a copy of that bill, invoice, or whatever supporting documentation that you have for that request. Certain bills can be paid electronically to those vendors that participate in the national ACH list. So things like big national vendors like Verizon, Con Edison, really a whole hundreds and hundreds of vendors were able to pay those funds electronically with a wire transfer, which makes it possible for us to pay bills even faster. Because as you can imagine, if someone receives their money on the 3rd of every month, the trust will not typically have that money in the account until maybe the 4th at the earliest. And then the trust needs to wait for that money to clear to ensure that those funds are in fact available before we can go start using it to pay bills. So we have a short window of time that we are going to be working with to pay these expenses. So if there's a way that we can identify bills that can be paid electronically, again, those larger bills that can be paid automatically each month, it can help us pay bills in a timely manner. I also want to point out things like rent or mortgage. Sometimes rent is due on the 1st of the month and your landlord will not give you any grace period on that. So if your money's not clearing and available at the trust until the 8th of the month, there's no way that the trust will be able to pay that bill by the 1st, obviously. So there are ways and strategies that we can use to help someone make sure that their rent is paid on time. What we might do is we might get a month ahead on their rent so that every month the trust pays their rent at the end of the month for the following month. So the process of getting this set up, determining what bills someone might use the trust for, and getting those days and times to work out can be a little bit of, it can take some planning. And so that's why it's so important that when you're considering using a pooled trust, you know that you can get in touch with that agency who can help your clients navigate this process. Help them choose what trust, what expenses are going to be most beneficial for them, and get them set up in a way that those bills are being paid on an ongoing basis. Again, anytime we can use automatic payments, that's going to make it easier for the beneficiary, their family, and reduce the amount of paperwork that they need to send into the trust. In our program, currently we have eligible automatic payment options of rent or mortgage. Again, these are going to be fixed, recurring monthly expenses. We can pay condo maintenance fees and property maintenance fees that are fixed on a monthly basis. We recently added this as a new benefit. So this is a new service at NYSARC where we're able to do utility bills that are on a budget plan or a balanced billing plan. So if you have clients or if you yourself are using our services and you are eligible for one of these plans, we encourage you to contact us and get your utility bills set up on automatic payment. Again, it's going to reduce the amount of paperwork you need to send to the trust on a monthly basis. And we can also pay things like car loans, lease payments, or contribute a certain amount each month towards an irrevocable pre-need funeral burial plan. And if you have other fixed recurring monthly expenses, we encourage you to contact us, submit an application, and we can work with you to determine whether or not that's something that we can put on automatic payment. Here's a quick overview of the most common types of disbursement requests. Most individuals are going to use the trust to pay those monthly living expenses. That is what we're going to prioritize before paying for anything else, because we need to make sure that your money is being used to put a roof over your head. Make sure that your bills are being paid and that you have food in your fridge so that you are able to get care at home that you need. So we're going to be getting a bill to pay your rent, your utilities, cable, cell phone, maybe you have a loan payment, things like insurance premiums, may even be things like subscriptions to magazines, newspapers, or streaming services. Any bill that you have in your name, you can send to the trust and the trust will consider that for payment. You can also have someone go out and buy something for you and seek reimbursement from the trust. Now, again, this can't be your spouse or your legal guardian, but it could be your adult child who's assisting their parent, who goes out and buys groceries for them, holds on to that receipt and sends it to the trust with a proof of that payment. And the trust will cut a check and reimburse that person for buying that on behalf of our beneficiary. Another way, if you don't have somebody to help you or somebody who has the financial resources to help pay for your expenses, you can use a credit card. You go out to the store, you use your credit card to buy your the things that you need at the store. You hold on to those receipts and you submit that with a form requesting for us to pay those charges on your card. Now, again, we only need to see itemized receipts for the purchases that you're asking the trust to pay for. And that's to ensure that we're paying for expenses that are allowable, and also so that we can monitor that spending to ensure that the money is in fact being used only for the primary benefit of the person who's participating in the trust. Other expenses might be larger purchases. Maybe you want to do some repairs to your home. And so in order to do that, you want to have someone come in, kind of assess how much work needs to be done. You might get a quote or an invoice that you would send over to the trust to get kind of pre-approval to move forward with that prior to doing any of that work. Or maybe you want to make a larger purchase of a piece of electronics equipment or a furniture where you're going to go out and do some shopping, send what you would like to purchase to the trust, and the trust will work with whatever vendor we're purchasing that from to make that purchase on your behalf. Here's just a quick summary of some of the eligible items, many of which we've gone over already. And I want to ensure that I emphasize here that this is not an inclusive list. This is just a list of some of the most common things that someone might use the trust for. As I mentioned earlier, we're primarily going to be looking at, for someone who's receiving community-based Medicaid benefits, we're going to be looking at paying those monthly living expenses that are going to make it possible for them to stay at home. Some people, however, have high spend downs. Maybe they're living with a family member and they don't have a lot of monthly expenses, where they may need to use the trust not only for those bills each month and expenses they have in their name, but it can also be used for things that are going to improve their quality of life, like maybe additional services that aren't being covered by their health benefits, therapies or companionship services that would allow them to go places. And even things like entertainment and recreation, things that make them happy, that allow them to have a better quality of life. It could be things like haircuts, going to get your nails done. What are things that make that person more comfortable? It's very unique to the individual and what they want or need. And there really is an infinite list of things that we can use the trust to pay for. So if you have questions, or if someone is struggling to determine how to use the money in their trust, we encourage you to contact the pooled trust. We have many, many years experience doing this, and we have seen it all. So we're here to help you get creative in determining ways that you can use this money in the account. There are some things we cannot pay for, and I've gone over a few of them. Cash to the beneficiary, or putting money in a bank account that the beneficiary is on. And that includes if you and your parent have a joint bank account and you go out and it's maybe, you think it's not their money, it's just your money in there, but their name's on that account. If their name's on that account, it is considered all their money. So if you go out and buy anything out of that account, we will not be able to reimburse you, because that would be considered their money and we cannot reimburse the beneficiary. So just be sure that if you are buying something for your loved one, that you are purchasing it out of an account that does not have their name on it. We can't buy gifts for other people. These have to be for the primary benefit of the individual we're serving. But for example, if you live with your spouse and you want the trust to pay rent, We're not going to prorate your rent when you live with your spouse. You're obligated to pay that rent, and we're going to be able to pay the full amount of that expense. However, if you live in an apartment where you share that with a friend, that may be where we would prorate and only pay your portion of that rent or other bills that you may be jointly on the account. We can't generally buy items that are intended to be provided by government benefits, because that could cause a reduction in the services that a person's receiving. However, again, we evaluate those on a case-by-case basis so that we can determine what is in the best interest of the person that we're serving. We can't make capital improvements to a property that's not owned by our beneficiary. If I need services and I live in a home with my adult daughter and her 4 children, any sort of improvements to that property are going to go towards that property owner primarily, not me, a resident in the home. However, if I own the property, we can consider improvements to that property, because that would be for my primary benefit. I will receive the primary benefit of that. We can't do leases between spouses. That is essentially putting money back into the household. So we would not be able to honor that. However, if David, for example, were to move in with his daughter, Mary, she could charge him rent for his room and board to live there. And the trust could pay a rent payment to Mary each month to cover the cost of his expenses of living in that home. We can't pay both rent and a mortgage. Essentially, someone needs to have one primary residence, and we can pay for that one primary residence. And it is a NYSARC policy that we do not pay for alcohol, tobacco, firearms, illegal activity, bail, or restitution. The whole purpose of this trust is to help improve the quality of life of the individuals we serve. And so we want to ensure that we are doing just that, because this is a program that helps thousands of people each year be able to stay at home. And we want to make sure that it stays that way. As someone is using the trust, there are many ways for them to communicate with the trust and be able to monitor the activity in their account. Our customer service team is going to be your best resource. They're available weekdays from 8:30 to 5. You can call, ask questions, get status updates on your account, and get assistance in managing the money in your account to use it to pay your bills. They can answer your questions about what documentation is required for a specific expense and help you come up with ways to use the funds most efficiently. We also provide multilingual customer support for individuals who may not have English as their first language. And in addition to providing monthly bank statements with an overview of the transactions in your account, an individual can monitor their account in real time using our online portal and automated phone system. The online portal allows individuals to not only check their balance, track the activity in their account to see when things are being received by the trust and processed for payment. It also allows them to download copies of their bank statements, trust documents that they may need to show proof of their trust or to recertify for Medicaid on an annual basis. And they can run verifications of deposit directly out of that portal. So we encourage you, if you're not already using this tool, to log in, check it out, and see how it may benefit you. It can also be used by a professional who's authorized to have access to a person's account. You can add as many accounts as you are authorized on and manage them all in one place. And for people who are not using the online portal or who maybe don't have access to a computer or just aren't comfortable, they can call the automated phone line and listen to a recording of their recent transactions 24/7. If you ever need a verification of deposit to be sent to your local Department of Social Services or HRA, simply contact NYSARC and tell us where that needs to go, and we can either send it as a one-time request or even an automated monthly request if that's required by your local agency. As I mentioned earlier, you can also download that report yourself directly from the online portal. And anytime Medicaid needs to see any sort of activity out of your account, whether it's for one specific expense or an entire history of a year's worth of expenses coming out of the trust, simply contact the trust and we can provide you with activity and reports for those types of requests. We maintain all documentation in a digital record keeping system. So we're going to have copies of all of the documentation that you have sent to the trust. That is one of the benefits of making sure that you're sending that documentation to us at the time that you're using money in the trust. That way, if you're asked for it in the future, you know you can always go get a copy and provide that to Medicaid so that we can ensure that your services continue. And as we mentioned earlier, the trust also handles any sort of tax reporting for the trust. And that is charged once a year in that $50 tax and audit fee. So now that we've gone over how to use a pooled trust to help someone qualify for Medicaid home care services under the current rules, we want to give you guys just some quick updates on some of the changes that are coming or that may already be active. Right now, and there's been a number of changes that have been proposed over the course of the last couple of years. However, many of them have been delayed because of the ongoing pandemic. The state is currently receiving a significant amount of funding from the federal government to support us during this difficult time. And because they are receiving that funding, they cannot make it more restrictive to qualify for these benefits. Otherwise, they would not have access to that funding. So there are a number of these rules that are continuing to be delayed. One that has been recently implemented is the new independent assessor process for an independent agency to be determining whether or not someone is eligible to receive home care services. So this is a process that was being provided by Maximus previously, and also involved your own primary care physician in that process. This is now taking those individuals out of this equation, and there's a new review process. This has gotten started so far. And really the important thing to note here is that there's a lot of questions we have on how this is going to work. There's also now going to be an independent review panel in the case where an applicant needs more than 12 hours of care. So these are new hurdles that someone may need to overcome in order to qualify to receive home care services. The point here being that it's not getting any easier to access these services. Now, it is also important to note that because of some of the challenges that we've been seeing with this new process, the independent assessor has been delayed for immediate need cases. And at this time, it's being delayed until October, and we don't know whether or not they will further extend that. Some other changes that are coming once we are no longer in a state of public health emergency will be things like an increase to the number of activities of daily living that a person needs in order to qualify for personal care services. So again, where right now you're eligible with, a handful of ADLs, that total number you're going to need to qualify is going up. So again, just making it more difficult for people to access these services. And another one, which is probably the most popular that many of you are familiar with or have been hearing about, is the implementation of a community Medicaid look-back period. So some of you may be familiar with the 5-year look-back period for nursing home care. When you go into a nursing home, they're going to look back 5 years to see if you moved any money out of your name so that you could qualify financially for Medicaid to pay for nursing home care. Now, up until very recently, and at the current time, there is no look back for community-based services. So if I need care, but I want to get care in the comfort of my own home, I'm able to take the money out of my name, transfer it, doing many strategies to transfer that money, and I can be eligible and qualify for Medicaid in the following month without being penalized for those transfers. So it makes it possible for someone who needs home care to get it very quickly, even if they have money that needs to be spent down, because there's currently no look back period. Now, that is potentially going to change in the future. It was initially announced in the 2020 budget. So it's been many years now that this has been delayed. And what we understand at this time is that because the public health emergency has been extended yet again, this is going to be delayed even further. But when it is in fact implemented, and if it is at some point in the future implemented, this look back period will apply to non-exempt asset transfers that are after October 1st of 2020. So if you made transfers before October 1st, 2020, those should not count against you. And if you did make transfers after October 1st, 2020, as long as you apply for home care services prior to this community look back going into effect, it is our understanding that those transfers would not be penalized either, because you're going to be applying for the benefits under the current rules, which do not have a community Medicaid look back. So 2 important things to note here. First, community Medicaid look back is being further delayed. We don't know at this time what date they're going to implement it. We can certainly speculate, but because for 2+ years we have been seeing this delay, again, I think we just need to know that this is coming on the horizon. The second thing is that if you are in need of home care services now, and you've been considering applying for Medicaid, it may make sense for you to get that application started sooner rather than later, so that you can become eligible for those services under the current, more relaxed rules. Now, the Department of Health has indicated that this look back may not apply to people that are in certain waiver programs. So that would be one positive. And again, a lot of this is still really up in the air. If you are not maybe in need of Medicaid services right now, but you know that you're going to have assets that need to be protected so that you can qualify for those benefits, it would be a good time to seek the help of a professional to help you be considering what would be the best option for you so that you will be eligible for these services in the future. Now, one of the big questions from many people is, what does this mean about pooled trusts? The important thing to note is that pooled trusts will still be something that someone can use. Regardless of the community Medicaid look back, an individual is still going to have potentially excess income that they would need to put into a pooled trust. And from what we understand, pooled trusts are going to still be allowed. And there's just a question of what would be the requirement as far as spending that money on a regular basis. How will someone be able to prove that they are going to be able to use all of that money? And that's a big question for all of us that we don't have an answer for at this point. Once we get closer to an actual implementation date, we should get regs that will give us more information there. How will people be able to manage these accounts going forward? But the important thing to note is that this will still be an available tool for people who need to spend down income. And we will help you guys navigate how to help ensure that you can use all of that income or as much of that as possible if you're in need of care in the future. So with that, we want to open things up to questions. I've been seeing the Q&A light up throughout today's presentation. We understand you probably have many questions. Before we do that, I just want to point you to the screen here with all of our contact information. Some of the questions you might have may be very specific to your financial situation or a client that you're working with, and you might not feel comfortable asking it in this public forum. So we encourage you to reach out to us if you have questions, or if you think of something after today's presentation that you want to know the answer to. We are here to be a resource to you. NYSARC Trust Services, as I've mentioned, has been doing this a long time. We're actually, as of this year, celebrating 50 years of trust administration experience. So we're here to be a resource to you. We're here to help you and your clients navigate this process. You don't have to feel like you're alone in this. And as we've mentioned, there are some things that we know about the changes that are coming for Medicaid, and there's still a lot that we do not know. So follow us on LinkedIn, like us on Facebook, and join our mailing list, because we do regular trainings and we will be providing updates as new information becomes available in the future. So with that, I'm going to ask Nina to unmute yourself. If you can walk us through some of the questions that people have.
Okay, we do have quite a few questions, so buckle in.
Wonderful.
So just to make sure everyone's aware, one of the first questions was, when will the PowerPoint become available?
So we will get that to everybody after today's training. Once we leave the training, we're going to get a report of all the individuals who attended. We're also going to have all the people who registered to attend and were not able to join us. And we will send an email out to everyone with copies of today's slides.
Great. For those who may have missed the explanation, what is the trust beneficiary?
The trust beneficiary is the individual who is benefiting from the trust. It's also more commonly, a term that you may be more used to is it's the Medicaid applicant. So it's the person who is being required to spend down income in order to qualify for these services. They are the beneficiary of the trust, the person who's benefiting from putting that money into the trust, not only to help them qualify for benefits, but so that money can be used for that person to pay their bills.
Great. How are sources of income that are one-time payouts counted when applying or renewing for Medicaid?
That would be a good question for Medicaid. As I stated earlier, the pooled trust does not calculate a person's spend down or determine their eligibility. So when it comes to calculating a person's income, you're going to want to direct any questions to Medicaid. We understand there's certain things that may be a one-time income stream, and I'm not exactly sure how they go about distributing that. There may even be some individuals here on the call that might know more about that process. Someone like an elder law attorney who is familiar with community Medicaid application process. There's also Medicaid kind of application agencies that understand those rules much better than we do. So we encourage you guys, for any questions you have about, not as regular income, to direct those to your Department of Social Services or someone who might be assisting you with the Medicaid application process.
Perfect. Do the spending limit increases in 2023 apply to both over 65 and under 65?
So it will apply to people who are over 65. It's going to apply to people who are in the age, blind, and disabled category. So they may also be under 65, but they're subject to the non-MAGI limits because of a disability. So they could be under 65. And then for that MAGI population who are typically under 65, they're going to be the same limits. So that's the whole purpose, is getting those to be the same.
Okay, thank you.
Mm-hmm.
How does a spend down apply if someone is over the asset limit?
So if someone has assets in their name that are also over the limit, that's the first thing that they need to take care of before they get started with applying for Medicaid. And there's many ways for someone to spend down those assets. In certain circumstances, if it's a small amount of money, maybe they're only $10,000 over the limit, they might set up an irrevocable pre-need funeral arrangement for themselves. That's going to eat up that money, and they would then be eligible to apply for Medicaid. If it's larger amounts of assets or assets that they want to ensure do not go to Medicaid to repay Medicaid for the services provided to them, that's when they might seek the help of a legal professional who can do a variety of different planning things to help them get below those limits. In other cases, if someone is receiving Medicaid or SSI on an ongoing basis and they come into a sum of money that's going to impact their financial eligibility for benefits, they could potentially deposit that money into a pooled trust to maintain their eligibility for those services, or some other qualified special needs trust. What options, are available to someone, and what might be the best thing for them is going to be based on how old they are, what benefits they receive, and how much money we're trying to protect. So again, if you have specific questions, we encourage you to contact our organization or a legal professional to, evaluate what might be the best fit in that particular person's situation.
Great. Does a person have to prove why they no longer need the trust or just stop paying for it?
That may be different for each pooled trust and different depending on the reason, right? So typically, the most common ways that someone stops using a trust, if you're spending down your income for a pooled trust to receive home care services, oftentimes at some point, you may need to go into a nursing home where you no longer will be able to put your income into a pooled trust. That income will now go to the nursing home on a regular basis, and you're not going to make any more deposits into a pooled trust. If that's the case, you're going to contact the pooled trust, let them know that they're going into a nursing home permanently, and that you no longer need to send that spend down to the trust. In that case, we typically don't require that you send any sort of documentation. However, we do inform Medicaid that you're no longer paying your spend down to the trust. So not necessarily something that's required. Other times it may be because you're just moving out of the state. You're no longer going to be receiving New York Medicaid benefits. Or in some cases, your care needs have progressed to a point that you no longer need those services. And again, we're not typically going to require any sort of proof of that, but we will work with you to just make sure that you understand that if you do, in fact, still need Medicaid benefits and you do need to pay the spend down and you're not sending it to the trust, that you need to make sure that you meet one of those other requirements to meet that spend down. Otherwise, you could owe Medicaid in the future for services that you received during that time. And again, anytime someone stops using the trust and stops sending deposits, we are going to inform your local Department of Social Services that we're no longer receiving that spend down.
Great. Thank you, Sarah.
Yeah, absolutely.
Does someone with surplus income and has home care pay the surplus directly to the home care agency or directly to Medicaid? I've been hearing that some people are being told that the spend down needs to be paid towards the home care agency.
So the answer to that is no, not necessarily, depending on the person's situation. So just like paying Medicaid to meet your spend down, oftentimes, instead of paying Medicaid, if you're enrolled in a managed long-term care plan, that managed long-term care plan might be obligated to collect your spend down, which is another way for you to meet that spend down requirement. You can pay your managed long-term care plan that amount of money, but that leaves you with very little to live on. And as long as you have a qualifying disability and you're eligible to use a pooled trust, you can still use a pooled trust. You just need to let the home care agency or the MLTC know that that's where your spend down is going. They cannot require you to pay it to them. If you are eligible for a pooled trust, you can put that money into your pooled trust. We do see this often. So really, if you're hearing this, you need to file complaints. You need to reach out to this agency. You need to get them the information about your pooled trust so that they understand where your spend down is going. Sometimes it really is just a clerical issue where the MLTC just was not informed that you were using a pooled trust. And so they're going to reach out to you asking for it because they're required to collect it also. And unfortunately, we have seen situations where the individual is confused and they're double paying their spend down to the MLTC and the pooled trust. So it's really important for people to understand that these are options. You can pay the money to Medicaid, you can pay the money to your MLTC. Those are ways to meet your spend down, but it leaves you with very little to use for your living expenses. So if you need that money to pay your bills, you can use a pooled trust. You just need to inform Medicaid or your MLTC that that is how you are meeting your spend down on an ongoing basis.
Next question. I understand that Medicaid will claim any assets in the pooled income trust when the community Medicaid beneficiary passes away. But what about assets in the deceased name, such as their checking or savings account balances? What about the balance in their IRA account?
Right. So when a person passes away, assets that they have in their name are going to go to their estate. I am not a legal professional, and I'm not a trust and estates attorney. So if you have questions about specifically that process and how it works, we encourage you to seek advice from a legal professional. Certain assets are going to be subject to potential recoupment from Medicaid. And again, it's whether or not Medicaid actually acts on that or not, right? If there's an outstanding lien, they are going to potentially, file to your estate to recoup funds from that. It could be money that's available to you, like a checking, a savings account. A retirement account, however, is going to go to your beneficiaries. That is an exempt asset for Medicaid purposes. And as long as you are, again, taking money out of it, as long as it's in payout status. And so money that's in a retirement account is typically going to transfer to your beneficiaries that you have named to receive that money after your death. So that is one account that is protected in that way, as long as you have beneficiaries named on that account. But any money that you put into the pooled trust out of that account that was part of your Medicaid spend down, you want to make sure you're using that on a monthly basis. Otherwise, that money would be subject to, it would not go to your loved ones at your death if it's in the trust still.
Great, thank you. We have a couple questions about POAs, so we're going to address those all together. The first one was, can you set up a pooled trust with the POA? And then the person commented that you did answer it during the presentation, that yes, you can have the POA establish the pooled trust on behalf of that person.
Yeah, typically a power of attorney would give you the authority to go and set up the account for your loved one and sign that joinder agreement on their behalf. However, that power of attorney must be a valid power of attorney. And I say that because many times people either go online and just get an online power of attorney form, or they might just go to their family lawyer and that lawyer might do a power of attorney for them. And it may not include the appropriate powers that would allow someone to establish a trust for their loved one. So if you are a power of attorney and you are establishing an account for your loved one, you're going to need to provide a copy of that power of attorney with the application. When you sign the document and it says relationship to beneficiary, you're going to put power of attorney in that field. You're not going to put daughter or son or sibling. What gives you the authority to sign that document is that you are the power of attorney. So you're going to sign it. When it says relationship to beneficiary, you're going to put power of attorney, and you're going to include a copy of that power of attorney for our team to review. Our attorney will review that, confirm that it is in fact a valid power of attorney that gives you the gifting powers that you need in order to establish a pooled trust on someone's behalf. And as long as that is all in order, then you would be able to open that account for them. If you did not go to an attorney that understands these rules and your power of attorney does not give you those gifting powers, then you may not be authorized to establish account for your loved one. So again, that's getting a little bit into the weeds. I just reiterate, I'm not an attorney. And so if you have a question about your power of attorney, I would recommend you either have it reviewed by a legal professional or just work directly with the attorney that you who drafted your power of attorney to just make sure that it is giving you that appropriate power so that you can establish the trust for your loved one.
Yes, thank you. Then we have a question, can a power of attorney be a caregiver?
I don't see why it wouldn't be able to be a caregiver. My understanding is that it could, but again, I'm not an attorney, so I would encourage any questions you have about setting up a power of attorney and what is a valid power of attorney and who can serve as power of attorney. Speak to an elder law and special needs attorney or a trust and estates attorney that understands these rules and can confirm that for you. But from my understanding, yes, many times it is an adult child who is caring for their loved one.
Great. We have a question in the chat right now. If a client is legally blind and has a POA, can the POA sign off on the documentation needed to enroll in the trust?
So the question is, if the person has a valid power of attorney, can they sign the document on behalf of the beneficiary?
Yes, to enroll in the trust. That's what it sounds like.
Yes, so they can. If someone has that and they want someone to do that for them, but it can also be signed by that individual themselves or attested to by someone kind of witnessing someone filling out that document. So it doesn't necessarily mean that just because someone is blind that they would need a power of attorney to sign the document for them. And the same can be said for someone who may not have the ability to write.
Okay. And then one more POA question. How does someone with no loved ones rely on and have cognitive decline continue to keep on top of the paperwork with pooled trusts and monthly deposits? This person has never established a POA.
Understood. So in a situation where someone might not be able to manage this process on their own, and they don't have someone who can sign the documents for them, the first step would be, if they don't have a power of attorney, to consider whether or not they have the capacity to sign the document. And by that, I mean, even though you may have mild cognitive decline, like our example, David, we may be able to sit down with David and explain the trust and the need for it. And if he's able to understand that at the time that we're speaking about the trust, then he may be able to sign that document for himself without the requirement of a power of attorney. If he's not able to understand that, and there's no power of attorney in place, that may need to be a situation where we would have to seek guardianship for that person in order to establish the account for them. You may need to petition to a court. And those are rare circumstances, but it can happen. So if you have a situation like that, we encourage you to contact us and we can work with you through that. Beyond that, let's say he is able to establish the account for himself, but you're still concerned about his ability to manage the account on an ongoing basis. So even if you don't have loved ones or family members, the individual can name any person who can assist them with that account. So we work with not only families, but providers, case managers. We work with people, their home health aides. I mean, they can authorize anyone to assist them in managing this process. And in addition to that, there are many ways we can try and automate this process for them so that there's very little work for them. Like if their spend down is $1,000 a month and their rent is right around that same amount, we can electronically deposit the funds into the trust and automatically pay out their rent, and there's very little work involved. So it's really going to vary depending on a person's situation, what we can do to help them. And in certain circumstances, if someone has no one and their situation is a little bit more complicated, we can assign what we call a beneficiary liaison, where we hire someone to support them through this, and that is paid for out of their trust account.
Great, thank you.
Yeah, absolutely.
Why does it's probably a question a lot of us want to know the answer to. Why does it take so long for the Medicaid application?
I don't know if I have a good answer for that, but I mean, it takes so long because there's a lot of documentation that needs to be provided. The Medicaid needs to review all of that documentation. They're not only checking what you gave them, they're checking to make sure that they have even things that maybe you didn't provide to them. So it's a process that they have to go through, and they're processing a lot of these on a regular basis. So there's a long queue of people that are trying to get access to these services. And so, it is a lengthy process. So it's something, that you really want to be thinking about, especially if you're in need of care now. And sometimes it requires families to get creative to make sure that what the person needs is being provided during that period of time, where we're waiting for services to be in place. So I don't know if I have a good answer for you on that, but I think we're all curious about that. But I think generally it is just that the work involved in reviewing all of this paperwork is a lot. And there's many, many people who are seeking eligibility for these services.
Does the trust need to have sufficient funds in order to pay out for items such as rent? How does someone with a rent of $1,500 monthly and have a newly established trust pay their rent during the first month under a trust service when $300 in excess income was deposited?
Right. So just to reiterate, the trust can pay expenses up to the amount of money that we have available in a person's account. A trust does not just get open and pay people's bills. We pay based on what we have available. So if someone has a $1,500 a month rent and they decide to open the trust the first month with only $300, then they're not going to use the trust that month to pay their rent. And not all of their money is going into the trust either. So they're going to pay their rent with the money that they have outside of the trust. Now, if the concern is that because of the cost of establishing the trust, someone's bills are so tight that would make it so that they couldn't pay their bills that month, then we need to look at, are there family members who can help? Is there another way for them to get money? And in certain circumstances, you can contact the trust and see about possibly charging the enrollment fee for the trust over a period of time. That way they're not incurring that expense all in one lump sum in the first month. Another more common situation is that a person's spend down may not be the full amount of their rent. So what they're putting into the trust, let's say, and what they have available is $700, but their rent is $1,000. So there's a couple ways we can handle that. We can either pay part of the rent, where we pay the $700 that's available each month towards the rent, and then they pay the remaining balance to the landlord separately outside of the trust. Another option would be for them to deposit more money into the trust so that they can pay that expense in full. Now, I don't typically recommend that option because we don't want anyone putting more than what they're required to in the trust for two reasons. One, if they were to pass away suddenly, that's more money that could potentially be left to the trust. So we want to encourage them to only put in what you're required to put in. Another reason is that if you increase your deposit amount, that may increase your monthly fee. So if you are doing that because you're more comfortable doing that, you want to make sure that your landlord's getting one check every month, then let the trust know that that's why you're depositing more money. And we can take a look at your fee to make sure that we're only charging you based on the amount of your spend down, since we're still only using it to pay that one bill, right? So that is something we see all the time. Just based on a person's spend down, they want to use it for rent, but they don't have enough money each month to pay it. We can use one of those options. Or another option would be to pick a different bill. Pay the rent out of the other money that they have and use other bills to send to the trust. So there's lots of different options that we can help someone with in that situation. So again, we just encourage you to contact us in those situations, and we can help you or your clients navigate that.
Great. It sounds like you just addressed this question, but just to reiterate, if you deposit more to cover the cost of your rent, does the client have to pay an additional fee for paying over the spend down limit?
It's going to depend on the trust that you're working with. In our case, if you inform us that that's the reason, we will consider reducing your fee so that it's based on the amount you're depositing each month and not charging you. And in some cases, it may not push you into another fee bracket. Like, our fees are flat and it's a sliding scale based on a range. So let's say that you're putting in $1,000, your spend down is 1,000, but your rent is 1,200. Just depositing an extra $200 might not change your fee. So in some cases, there would be nothing that would be needed to be done. But if the money that you're putting in that's extra pushes you into another fee bracket, that would be when you want to make sure that you inform the trust that the reason you're putting more money in is for that purpose. And the trust will evaluate reducing your fee based on that. Again, I'm going to always encourage people never to put more money into the trust than they are required to. But we understand in certain circumstances that makes things easier for people, or they're just more comfortable with that. And that is up to you to do. But just make sure that if it does in fact push you into a new fee bracket, that you let the trust know that that's why you're putting extra money into the account. And again, I can only speak for NYSARC on that. I don't know about other pool trusts and how they treat that, but that would be something you could ask the pool trust provider.
Okay, what do you feel or recommend is the most credible source to get Medicaid application information, i.e. like determination of disability, documentation requires, etc.?
So if you have questions about what documentation that you need or how to do disability paperwork, what forms are required, and making sure you have the latest forms, you need to go to Medicaid directly, or your local Department of Social Services, or HRA if you're in New York City. The New York State Department of Health should have these forms, but personally, I've looked for them myself and they're not so easy to find. So contact Medicaid, work with them directly, or we understand, and especially during these times, Medicaid can be very difficult to get in touch with. And so another option would be to work with a professional that does this for a living, that they help people apply for Medicaid, and that is the service that they provide. And they are going to be more knowledgeable about what paperwork is required and what you need to get started with an application. They're probably even going to be a better resource, perhaps, than Medicaid. But one important thing to note about that is that you want to be sure that you're not only working with a professional that specializes in this area, but also one that specializes in Medicaid home care applications. There are many legal professionals that might work with Medicaid for nursing home care, but are not as familiar with the rules as it pertains to home care eligibility. So when you're pursuing assistance from a professional, I would advise you to ask that professional about their experience with home care applications. Ask them how many home care applications that they do on an annual basis, and ask them how long they've been doing home care applications for, so that you can ensure you're working with a professional that's up to date on these rules and can help guide you to get you the right requirements of what you need to provide in order to become eligible for these services. I hope that answers your question.
Yeah, and to build off of that, we have another question. Can you recommend any low-cost or free agencies in New York that can assist individuals in establishing a pool trust and applying for Medicaid?
Yes, so there are lots of free resources across New York State. Some are administered through a program called the Facilitated Enrollment Specialists, I believe is the term. And these are agencies that receive funding from the state to assist people in applying for Medicaid benefits. So they're being paid for by the state, so that's free to the individual. And honestly, there are so many of them that I can't recommend any single one. but you could look for a facilitated enrollment program in your area. Often these are managed by independent living centers. You may be able to contact your local New York Connects. And they may be aware of some of the services that are available in your area. And there are many agencies, offices for the aging, that really are dedicated not only to maybe helping with Medicaid applications free of charge, but who understand and know the resources that are available in your area. NYSARC is a statewide organization. We cover all counties of New York, and we provide services to people in any county. So I'm always hesitant to provide any sort of recommendations because everybody's counties may be a little bit different. So we encourage you to seek out one of those types of agencies, an independent living center, an office for the aging, New York Connects, or one of those facilitated enrollment programs that may be able to give you more information and help you get started. And again, those free resources can be a great fit for someone when they don't have a very complicated case. But for someone that has significant assets or more complicated assets that they may need to protect, those resources may only be able to get them so far.
Great, thank you.
And those programs will often refer people in those situations to a professional who can provide that level of assistance.
Great. Are pooled trusts interest-bearing accounts?
So each pooled trust, it depends on what type of account you're using, of how that is going to be structured. For this particular account, because the individual is depositing the money into the trust and needs that money available to them each month to pay their bills, we do not typically invest this money. And so, yes, there could be some nominal increases in the funds. It is held in cash, but there could be some interest increase, but it's going to be very nominal, especially because of the transactional nature of this trust, where you're depositing your $1,000 and that $1,000 is coming out of the account in that same month. So there's typically not a lot of opportunity for growth when someone is using the trust just for income. Now, if somebody is using the trust because they receive Medicaid or SSI benefits and they come into a lump sum of money, that would be an example where that money would be invested and that money would be subject to market fluctuations of those investments. And it's also going to vary depending on what program you're using. Not every pooled trust in New York State is a full service pooled trust like NYSARC that offers first party and third party pooled trusts and partners with a financial institution that is a fiduciary that has almost 200 years of wealth management experience. So in our programs, that money is invested for people who are depositing a lump sum of assets. And that is going to be managed by the financial institution that serves as our co-trustee. Other trusts may take assets, but they may invest those funds differently. So I would encourage you to ask the trust that you're working with, what is the strategy that they use for their trusts. But going back to the income spend down, typically that money is going to be held in cash and have very nominal opportunities for growth.
Thank you. Can a healthcare proxy be the signer of a person lacking capacity?
For the joinder agreement to establish a pooled trust, no. Healthcare proxy does not give you the authority to make any sort of decisions as it pertains to someone's financial assets. It allows you to make decisions regarding their healthcare.
What is the easiest way to do a comparison between different pooled trusts? Is there a list somewhere? Relatively, is there a helpline that can help someone who has ongoing questions around selecting a trust?
That's a great question. So if you Google pooled trusts in New York State, there is a list out there. It's just a table It lists many of the different providers, and there's on the right-hand column with their contact, or sorry, the left-hand column with their contact information. And then the right-hand column often provides some sort of summary of their fee structure and their services, but that might not necessarily cover all of the information. And so I encourage people to just shop around, contact each of the trusts. Many professionals who help people in applying for Medicaid maintain their own lists of different pooled trusts that they trust, and they can provide that to you as well. So, I mean, there's many ways that people can evaluate these different options. There is not a helpline necessarily, but again, you can always pick up the phone and call the pooled trusts, ask the questions that you have, and compare the services that way. A question we often get is, can someone switch to a different pooled trust if they're not happy with their current provider? And the answer is yes. You can simply stop making your deposits to the one trust and just make sure that you open the new trust in time so that you can pay your spend down for that month. Now, we don't encourage people to do that. We encourage you to do your research up front and determine what trust is best for you at that time. Because even if the trust is willing to waive the cost of opening the account if you're moving from another trust, you're still going to have to go through that process again of applying and having the document notarized and all of that. So we encourage you to do your homework before picking a plan and make sure that you pick a plan that's best for you. And we know that a lot of people often choose a plan based on cost. They might just look at the fee schedules and pick the plan that is the cheapest option. And we understand that in certain cases, cost is a big deciding factor for someone. They might have tight bills, or they might also, just be looking at finding ways to keep as much of their money as possible. And we understand that. But the lowest cost option might not always be the best fit for someone. The most important thing, I believe, for when you're working with a pooled trust is, how am I going to be able to get in touch with them? Are they going to be able to assist me in managing this account? Am I going to be able to reach them when I need something? And are they collecting the appropriate documentation that is going to maintain my eligibility for benefits? So there's lots of factors to consider, and we understand that everybody's going to be looking at, different things that might matter to them most. But we encourage you to do that homework before establishing a trust, so that you don't get into a situation where you're going to need to switch to a different program in the future. Even though that's totally possible, it's just extra work for you or your family.
Are the steps to establish a pooled trust more or less the same, and will the required documents be the same regardless of the trust?
So first point, yes, generally all pooled trusts are going to have a joinder agreement to fill that the application to join the program. All pooled trusts are going to have a master trust document, which is the legal document that's drafted for the trust. Now, not everybody's is the same. And whether or not that master trust is valid or has been approved by Medicaid or Social Security Administration may or may not be the case. So generally, yes, the process of what you need to establish an account will be about the same. Each trust might have slightly different documentation requirements of what you need to provide in order to open an account. And some trusts might have different costs, that minimum opening deposit that you're required in order to establish that account. Now, when it comes to documentation, we are all subject to the same rules. The pooled trusts don't make the rules about how the money in the trust can be used. We simply follow the rules from the Social Security Administration and Medicaid. That's our job, is to follow these rules, know what they are. And so each pooled trust may have varying degrees of ways that they collect documentation for that and how they interpret those rules. So, while we are all subject to these rules and we are all subject to the requirement to maintain documentation, some pooled trusts might have different policies about how they maintain that documentation. And so again, I caution you that if you are working with a trust that is not requiring you to provide documentation for certain requests, that you are at the very least maintaining that documentation yourself. Because if Medicaid needs to see that at some point in the future, you want to make sure that you have that available. Or you want to be working with a trust that is in fact collecting that documentation and is holding on to that for you so that in that time when you need to provide it, it's already there and you don't have to manage that yourself. I hope that answers your question.
Can you pay a private aid directly from the pooled trust?
So if a person receives Medicaid services and they're getting a certain number of hours from Medicaid, but let's say that prior to joining Medicaid, the family was private paying for services and they were getting more hours. So they want to make sure that mom is still being taken care of for that amount. As long as there's enough money available in the pooled trust after paying your basic living expenses to contribute towards the cost of paying for extra hours, the trust could consider paying for home care hours. Now, I'm going to pull a specific word out of that question. We do not pay an aid directly out of the trust. The trust is either going to pay an agency for employing that aid who's providing those services, or if the family would like to hire that aid directly, then they need to go on the books and actually employ that aid. And they may need to use something like a payroll service to send invoices to the trust so that the trust is never paying that aid directly. The trust cannot pay the aid directly. That would be like we are actually employing that aid. And there's all sorts of risks that go around that come with that, including if you yourself, the family member, is paying the aid directly. And we understand that that happens all the time out in the community. There's a lot of informal relationships where you have an aid that you're very happy with. But we need to be sure that that aid is being properly paid, that they're filing taxes on that money, and that you as the employer are protected in the event that they fall and get hurt while providing services to you. Or let's say, like during the pandemic, you're not able to pay them, so they go and seek unemployment, and then you end up getting sued because you weren't actually properly employing that person, right? So that gets a little bit more complicated, but we have options available. So again, if you are wanting to use the trust funds to pay for hours of home care, contact us and we can review what options you have available based on your unique situation. It is possible, but we will not pay the aid directly out of the trust.
Okay, we have a couple questions about David and the scenario that we presented on. What happens to his house upon death?
So in David's case, he went to an elder law attorney and he placed that home into a trust so that that home could transfer to his daughter at his passing without being subject to repayment of any sort of Medicaid lien. If he did not do that, and let's even say before he passes away, he just has to go into a nursing home. Well, when he goes into the nursing home, he no longer lives in that home. And so that home will kind of be subject to those resource limits. And so at that point, they could put a lien on his house. So that's why it's so important, even though you can apply for home care services and apply for Medicaid and have a home, if you want to make sure that it can go to your loved ones, you want to make sure that you protect it in some way. And there's a variety of ways that you can protect your home. A trust isn't the only option, but it is the most commonly used option. And again, I encourage you to reach out to a legal professional if you have a home and you're considering applying for these benefits, because they'll be able to tell you what options you have available. There's also other ways, like there's certain exempt transfers. You know, if David was married and his spouse was still living in that home, he could transfer the house to his spouse. Or if Mary had moved into that home with him and she was providing care for a certain amount of time, he could potentially transfer it to her or to a child with a disability. So there's many options that might be available to someone, and what would be most favorable for you would be based on your family network, your resources. So again, we encourage you, if you're in this situation, you want to make sure that Medicaid is not going to take your home when you die, to seek the advice of a professional that understands these rules and can help you navigate what would be the best option for you in your situation.
Should David pay taxes if he established the pooled trust?
Are we talking about like property taxes or income taxes? If it doesn't specify, I guess I can kind of cover both.
Yeah, it doesn't specify.
So if he owns a home and he owes property taxes, that is something that the trust could pay for if he has the money available in his account. So when those property taxes come due, simply submits the taxes to the trust, and the trust is going to pay his local municipalities for those taxes. When it comes to his income, yeah, he's still going to be required to pay personal income taxes as he would whether he was using a trust or not.
In what instances would an SSI recipient require this type of trust?
So someone who's receiving SSI, supplemental security income benefits, is receiving those benefits because they don't have the ability to go out. Typically, they do not have the ability to go out and earn income on their own. And so they're receiving a monthly payment from the Social Security Administration in order to cover the costs of food and housing expenses for that individual. Many people with disabilities utilize SSI in order to be able to live independently in the community. And if you are eligible for SSI, any amount of SSI, then you can only have $2,000 in your name and be eligible for these benefits. Any amount of money that goes over that $2,000 threshold could cause a reduction or a complete loss of those SSI benefits. So if someone's receiving SSI and they come into a sum of money, it might be from a direct inheritance, a retroactive Social Security payment. Maybe they were in an accident and they're receiving a settlement. That money could cause them to lose SSI benefits. So rather than spending down that money very quickly, because in most cases, that either is not the most beneficial option for the person, or they just might not have something that they can spend it on that quickly, they're able to put that money into a pooled trust or a special needs trust in order to maintain their eligibility for SSI benefits. So it also gives people a way, if you're on SSI, to save money for future expenses. Let's say you're just, every month you're going just over that $2,000 resource limit. You can either spend that money down on things that you want or need before the next month, or you can make nominal deposits into a trust account, or in a situation where you may be eligible, you could put that money into an ABLE account. That's going to get that money out of your name so that it doesn't disqualify you for SSI benefits, and it extends the window of time that you have to spend that money. Another way a trust could be used for someone on SSI is that a family member or a loved one wants to be able to leave money to that person who's receiving SSI services without it causing any sort of interruption in the benefits that they receive. Because if we leave them money directly, they're going to have to create their own special needs trust in order to keep their benefits. So a family member can establish what's called a third-party trust with their money as a donor, and they can fund that trust for the benefit of their loved one. That way, that money goes into an account where it is not going to cause any sort of interruption in their benefits, but it will provide financial means to pay for things that their benefits don't provide. And that allows families to help plan for the future of a loved one with a disability and protect assets that they would be entitled to receive in a way that it will not cause them to lose those benefits. Now, NYSARC offers a variety of third-party trust options, but we just recently, for any of you that aren't aware of this, rolled out a third-party pooled trust for families who are in this situation and who may benefit from working with a professional trustee because they either don't have a family member who can serve as trustee, or they just do not have an appropriate person who they feel confident understands the rules and the requirements and the reporting to be able to manage this account in the best interest of their loved one. So that is another program that is somewhat new, that is available. We did a webinar a couple months back that is available on our website. If you're interested in learning more about that program, or certainly contact our office and we'd be happy to provide you with some more information.
Okay, we're probably halfway through the list of questions that we have at this point.
Okay, so in that case, Nina, I know we are over our time for today, and
Yes.
We are going to have to cut things short at 12:45. So let's go through what we can right now, and then if there are more questions that we haven't had a chance to get to, we will go through those. We can provide some written responses, and we can include that with the slides and the recording of the presentation when we follow up with attendees. And I do apologize that we haven't had a chance to get through all the questions, but I'm very encouraged by the fact that there are so many. It tells me that people are engaged in this, they're wanting to learn more. And so again, if there's something we didn't get to and you need an answer now, go to our website. It's a great resource. There's a lot of information there. Read the information and procedures document for the specific program that you're looking at. That will answer a lot of your questions, and contact our customer service team. We are happy to answer your questions and help you understand how this program works, how it can benefit you, a loved one, or someone that you're assisting. All right, Nina, go ahead and give me maybe one or two more questions. We've got about 5 more minutes.
Okay, we have a couple questions about spouses, so we can address some of those. How does a pooled trust work with spouses when only one spouse is in need of Medicaid?
Right. So this is a rule from the Social Security Administration that an individual account must be maintained for each beneficiary. So if one spouse is in need of care, that is the spouse who is going to be applying to use a pooled trust. That is the spouse who will be the beneficiary of that account. And they're going to be putting their income into the trust, whatever they're required by Medicaid. And then we're going to use the trust to pay their bills. So again, if they live with their spouse and they have to pay a mortgage or a rent, we're going to pay the full amount of that rent or mortgage as long as the person on the trust is obligated to pay that expense. They're going to submit their electric bill, their cable bill. We're going to be able to pay the full amount of that. We do want to see our beneficiary's name on that bill. So in most cases, that is the case. That's fine. If the person who is using the account is not on that bill, we're going to encourage you to have them added. The reason is Medicaid, that #1 rule, this has to be used for this person's primary benefit. So if Medicaid comes to us and they want to see what we're paying out of the trust, and we show them a bill that doesn't even have our beneficiary's name on it, they're going to question that. So what we need to do is we need to create a paper trail to document why that is. So we either need to have them added to that bill. That's the easiest, most simple thing that's going to make it as easy as possible for you to pay that on an ongoing basis. If, for example, and we understand that there are reasons why someone may not be able to be named on that bill, we're going to look at other ways we can verify that that service is in fact being provided to our beneficiary. So we might look at something like service address and confirm that that bill is being provided, that service is being provided at the primary residence where our beneficiary lives. We typically do not prorate expenses for spouses. Again, as long as we have the appropriate documentation and we can verify that that is in fact, those services are being provided to our beneficiary.
Great. You actually answered the next question in that we do not prorate things like mortgage between two spouses. We'll pay the full thing. And then I guess if this is our last question, if the trust is created in the husband's name and the husband passes away and pension and Social Security survivor benefits is passed on to the wife, does a new NYSARC agreement need to be created in the wife's name?
If the wife needs services and is going to have a spend down, then yes, the first thing is going to be to go to Medicaid and inform them of the change of the wife's income so that they can rebudget her spend down. And if she now needs Medicaid services, she would need to create a pooled trust for herself. And again, that would be kind of a unique situation where both spouses are needing care at the same time, or if she needed it at that point. Now, if she is the healthy spouse and her husband is the one using the trust and the husband passes away, yes, she might be getting more income, but if she doesn't need Medicaid, she wouldn't necessarily create a trust. The trust would just be if she needed Medicaid and had a spend down.
Great. Well, it's up to you, Sarah. We can keep going. We have plenty more questions.
I think we have time for one more. But before we do, and I would say maybe if there's any way you could prioritize and so far you've done fantastic. If there's any questions that we didn't already cover in the presentation, let's pull one of those out. But just on the subject of what we were just talking about, if both spouses need Medicaid benefits, because we can only maintain one pooled trust account for one person, it may be a question of who do you establish the trust for? Which one of the married couple do you establish the trust for? And in some cases, the married couple may choose to establish accounts for each of the individuals. So we want you to understand that decision can get a little bit complicated. And so if you are in that situation, or if you have a client who's in that situation, contact the trust and we can help you navigate that. It's unique, but it does come up, and we've been seeing it more and more lately. So we do want to encourage people to reach out to us, and we can help explain that in more detail in the context of your specific situation, because it is going to be very different based on how you are going to be using the trust and what the distribution of your assets are or income. All right, Nina, we've got time for one more question. And again, I thank everybody who's still sticking around with us almost 2 hours in at this point.
Okay, if a person is in New York State and they relocate to another state, is the trust transferable, or does the person have to apply for a new trust in a new state?
Yes, so that's a great question. One of the more common ways people leave the trust is that they no longer are receiving services in New York State. Now, pooled trusts are available nationwide, but not necessarily to spend down income. And so New York is one of only a few states that allow people to use pooled trusts for this purpose and for this reason. So as to a question of whether or not they need to set up a new trust in their new state to use this, to do what they're doing here in New York, that would be dependent on what state they're moving to and whether or not that state allows them to do this type of arrangement. There are very few that allow that. More commonly, what happens is someone moves to a state that does not allow that. And what they're going to do is, rather than transferring that money to another pooled trust in another state, which wouldn't benefit them because it's not required of them in that state, They would simply just spend down the assets they have available in the trust in New York. Now, if they were to move to another state where they were able to use a trust for a spend down, then yes, they would, they would have the option to create a pooled trust in that state to pay that spend down. And then again, the first, our recommendation would always be to just spend down what money you have in the account. Most people are not going to have a large balance because you're using the money month to month to pay your bills. And so you're just going to submit expenses to the trust until you reach a zero balance. If you have a larger balance or you just don't want to do that and you really are adamant about having the money moved to another trust, that would really be dependent on what pooled trust you were wanting to, or where you were wanting to move the money to. So that would be a situation where you would contact the trust and we could evaluate that. We would have to review the master trust of the new trust that you're looking at, and we would need to confirm that it was a valid special needs trust. So thank you so much, Nina. This is a good ending point, and I apologize. I normally would stick around and answer all of the questions, but we have another training to get to. And so I just want to thank everyone again for being here, for all of your questions. We had over 300 people participating in today's webinar, and we really are just so encouraged by that. And we want you guys to reach out to us if you have questions. So if there's something we didn't get to, or if you have somebody who you'd like to evaluate whether or not the trust would be a good fit for them, we encourage you to contact us. If you want to be kept up to date on these changing rules and what that's going to mean for Medicaid eligibility and home care services and using a pooled trust, we encourage you to get on our mailing list, follow us on social media, reach out to me directly if you want to be put on a list to get updates. We're here to be a resource to you, and we want to be able to help everybody navigate these changes, as we ourselves will also be doing that. All right, so thank you everybody so much for your time. We really appreciate it, and we look forward to working with you in the future.